Hello and welcome to today's episode of Ask an Expert with Claire. Today with us we have Michael Evans, who is the founder and fiduciary wealth advisor at Cogent Strategic Wealth. He spent his early career as a professional commodity trader before earning his financial planning graduate certificate and starting his own business. Michael noticed patterns repeated over and over, highlighting the difference in mindset between accumulating wealth and that required to preserve it. This is why decades of peer-reviewed financial research drives his wealth management philosophy. Like Michael, the research is compelling and reliable, and this same Nobel Prize-winning research drives the very investment strategy which his family, his team, and his clients use. I like that you walk your talk. It's helpful. He spent the past 23 years as an entrepreneur, husband, father, and friend, and his team currently services clients coast to coast. For a point of reference and clarification, a fiduciary financial advisor is an investment professional who is licensed with the US SEC or state regulators. And this is important for clients because they are legally required to put their clients' interest ahead of their own. Michael, thank you so much for taking the time and joining me today.
Claire, thank you so much. Appreciate the opportunity to discuss this with you.
I know you're pretty busy these days, so I'll jump right into it. With everything going on with the COVID-19 pandemic, I'm sure you're getting a ton of questions about our economic future, market trends. What would you say some of the top questions you're getting right now?
Sure. I think the biggest thing with the volatility that's out there now is people are just like asking, am I going to be okay? There is so much emotion wrapped up in this, both health issues and financial issues, not to mention everything else with family and employers and employees and all of that, that I think there's just so much stress. I think people just want to know when we come out of this on the other side, will I be okay?
That makes sense. It's questions I've had as well.
Yeah.
In terms of just where to start, I'm sure that these questions have been cropping up for you as well. I hear a lot about increasing your emergency fund, increasing your savings. What do you say to that?
Yeah, I totally abide by that too. And I eat my own cooking when it comes to that. So going into this crisis, I too have a very healthy, secure reserve fund. And it's important because then you can take risk in other parts of your life. So in your portfolio or maybe in your career. And then at the same time, you're able to survive and thrive through whatever comes at you. And just like pandemics, we never know what's going to come at us. So to be really well prepared, I think is the best place to start. Very much so. So reserve fund is great. And then in your portfolio, I think you need to really take a look at where your risk lies, both personally and professionally. We like to talk about the ability, willingness, and need for risk. So let's walk through that just for a minute here. The ability for risk is, what's your age? How's your income? What kind of business are you in? Just all the things. So think about the differences of a millennial that has a great degree that's in a highly employable industry versus a retiree that can't go back to work, doesn't have the skill sets to conduct a business online. So their amounts of risk that they can have the ability to take are different. Willingness, well, right now we just saw with a 30-something% drop in the stock market back in a month ago, that really tested people's stomach acid and like, how can I put up with this, check in their portfolios? So that's the second thing. I think you have to know yourself. And then third, the need for risk. So if you are an investor and you have to take care of yourself in the future, which I think we all have to do, and there's others, people counting on us, you really have a need for risk. But it differs for everybody. So tenured professor that's in works for a law school or whatever, that's really a good organization. They can take as much risk as they want because their tenuredness helps them out. Somebody that's in a sales job for a very volatile industry, like something in real estate or other things, you have to take a lot less risk for your situation because your human capital or what you do for a living is absolutely just like a stock itself, and it'll bounce around throughout your career.
I think, yeah, absolutely. You're right. Just having a plan to begin with and understanding who and where you're at is, what you do with your clients initially when you first sit down with them. And I think that's absolutely critical. Thank you. In terms of money moves out of fear, we talked about risk and, people's willingness to take risk, or if they're scared, how people's emotions are tied to this whole pandemic, and that influences what they're willing to do or not willing to do in these times. What would you say in terms of like your investments, making moves potentially if you were tied emotionally to them, just back to sticking with the plan?
Yeah, yeah, no, that's so true. And a plan is what you need. You have to have the confidence that you know where you're at and where you're going. And then you execute the plan with that ability, willingness, or need for risk. And you have to putting things in place like rebalancing when markets change on the upside or the downside. A lot of people talk about volatility only being negative. Well, over the long period, 3 of 4 years of the US stock market are positive. Now, they don't always come that way. We just had multiple years in a row that were positive, but you actually have to rebalance on the way up too, so you don't have too much risk when the risk shows up like it did now. But I think a plan is so smart. And the other thing that's really important, and I think it's an antidote to our own volatility, is education. I think you should know what happens in crises like this. I think you should be prepared to understand what your financial investments have done in the past of other crises. It'll never be the same, but it'll give you a view of what happens and prepare yourself for that. Being able to withstand the storm and be able to survive and thrive after that. I think that's so important. It's an anecdote to it. It absolutely removes that emotion from you making bad decisions. And we want to make sure investors stay on the right side of making a bad decision. We don't want that.
Absolutely. You touched a little bit on different trends over time that we've seen situations not exactly like this, but we've seen behavior like this in terms of the market in the past. Can you talk a little bit about trends over time? Because I think that gives me a peace of mind to understand. And you've given, we're both a member of the same resource group, and you've given us a really good presentation about a month and a half ago. And I know that that calmed my fears to see what the market trends were over time and how things always rebalance to make sure that you're sticking to your plan and giving you the confidence to stay with it.
Sure. If you're going to come out the other side of this intact and you're going to be able to survive and thrive, I think knowing the history of other things that have happened is really important. That'll give you some confidence to know how markets react. First, you should remember, why do markets go down? Well, markets go down in price because investors say there's uncertainty and there's things happening that maybe we don't have the clarity that we had before. So they back off prices. And what happens then is expected returns of those assets generally go up. So while your portfolio was wonderful on December 31st, on May 14th, because prices have come back, there's actually a higher expected return for a lot of your investments. And that's important to know. So your portfolio just didn't temporarily lose money. You actually set yourself up for the future. We looked back, going back to 1926, at all of the downturns that were 30% or more. And we looked at the 1 year, 3 year, and 5 year returns after the bottom was made. Now, don't get me wrong. You can never tell when the bottom is made till way, way longer in the future. And so I'm not calling a bottom. I'm not saying we already hit it or we may hit it in the future. What I'll say is once we took the bottom and put that in on a 1, 3, or 5 year returns, averaging out all those other downturns, we see that they're all positive. And especially on the 5 year return, it's actually positive by up 50% on average. So that gives us hope.
Absolutely. Absolutely. Thank you. That was very helpful. Pivoting a little bit, I asked you prior about budgeting. So not necessarily for your standard clients, but more for the average American, average household, 65 grand a year, in terms of percentage allocations to rent, mortgage, living, savings, investments, etc. And I liked your response because I think there's so much emphasis on extreme budgeting or cost cutting or stop getting a coffee every day. You know, you hear that kind of stuff all of the time. And I think your approach, I like it because I think it's much different and it's coming from a more balanced and attainable mindset. So would you mind just extrapolating on that a little bit?
Sure, sure. So let's take yesterday, for example. I talked to an MBA from Kellogg here in Chicago that now lives in New York. And at the same time, I talked to a doctor that lives in Southern Illinois. Think about their cost of living. Very different, right? So if I were to say, hey, you both make X number of dollars, but you should contribute this percentage or that percentage to your rent or whatever, they'd be very different for both of those people. So what I believe is the right way to do it is to pay yourself first. I think you should look at what you make and you should set your rest of your life up to be able to fund your future. So let's say this, you're making 50, 60,000, what the average is now for young professionals. you're making that money, you should put 10% away right away into either their qualified plan at your employer, or if you're self-employed, into an IRA. And you should save that. If you're under about at least the 12% federal bracket or under, you should probably use a Roth IRA. But anything over that, you should do it in tax deferred. But I think paying yourself is appropriate first and save. Now, if you're a professional, if you're that other person that makes so much more and you got a JD and an MBA, or you're a entrepreneur, like many of the clients we work with, that they have variable wealth, but it's much higher than average, I think you have to save a lot more than what you're allowed to save just in a retirement account. In order for you to be able to make good decisions later, you have to save as much as possible now. And that might be 20 or 25% of your gross income. And there are ways to structure that that are so tax advantaged that help you do that in a way that can help you grow wealth so much better. So I think you should pay yourself first. I think you should place a portion of your savings right away, make it systematized so you don't ever have to be making decisions about doing it. And that way you'll actually be able to buy into markets as they vacillate up and down, like right now. And you'll be able to come out the other side. And whatever that is in any crisis or even in your career, you'll come out so much stronger.
Good advice. In terms of what one should do with outstanding debt or cutting expenses or increasing earnings, because we're looking at record highs for unemployment right now. So still taking a look at where you're at, like you were saying earlier, rebalancing along your plan. In terms of outstanding debt, cutting expenses, increasing earnings, what would you say to all of those?
Yeah, sure. It was one of the very first things we wrote into this crisis was the 20 things you can do to prepare yourself for a recession. We saw it coming. Unlike most things that we go up against, this is clear. The entire world knows it's COVID-19. That's rare in financial circles, at least, that we get a downturn because of that. But what do I think you should do? First, you should look at your risks. Where does your risk lie? So you should make sure you have that reserve fund. If you don't have one started, there's a great New York Times article that talks about how to start that. Just Google New York Times and reserve fund, and they just wrote it about how you can start to apply assets towards your reserve fund. The other thing you should do is look at all of your expenses. If you're really hurting and you don't have the cash flow, medical and housing, those are the two things to prioritize. They can't take those away from you right now. Many governments have enacted things that give a lot of umbrage or buffer to someone that's struggling with that. I then think you should look at your debt. I think you should prioritize that. Take the highest cost one, and that's at the highest interest rate, and pay more of that. Make the minimums on the others. By the way, mortgage debt is really good. It's a diversifier. It's never the mortgage that sinks you. It's actually the house you buy. So you buy a house that's too much for you to afford and too much for you to maintain. It's not the mortgage that sinks you, it's the cost of the home. So just like that, paying 10 or 20% into your savings, I think you should prioritize where you live and how you live to be able to let you and your significant other or the spouse that lives with you be able to, one of the two of you, lose your job and still be able to maintain your lifestyle. And I think that's really important, to put yourself in a position where you have freedom to be able to make your way through situations and not just be a victim.
I like that mentality, and I think that that's especially pertinent for everyone to hear now too. No matter where you're at, that's key right now. I want to talk a little bit for a moment about the use of Betterment and Flourish, which is used for what and what are the benefits?
Sure. So first, let's back up. I think you have two choices on how to invest: active management and passive management. I think all of the evidence shows that passive management is the way to go. So think Betterment, Flourish is another. It's more of a cash base. Think like Wealthfront or Vanguard. Those offerings use passive management. So it's based on peer-reviewed academic data that has nothing to do if the manager has skill or luck. That's active management. So the data is in. We just looked at a 20-year study. It was appreciable. Out of the 2,400 equity funds that started in this 20-year study, only 23% of them actually overcame a benchmark of an index. So not only were you paying higher fees in both to the manager and in taxes, but you're also getting underperformance. I don't know who likes that in their life, to pay up to underperform. I don't. So passive management is great. The reason why we love Betterment and I love Wealthfront and things like that, but especially Betterment, is they use that academic peer-reviewed information to build portfolios. They automatically rebalance. They'll even tax loss harvest, but they construct highly diversified global portfolios that also put a little more tilt towards smaller companies. If you have value or smaller companies in your portfolio, you're going to beat just the S&P 500 over a very long period of time. And I imagine most of the people that we're speaking with today, I figure I have a 45, 50-year lifespan of investing, and people that are younger than me have so much more. So if you can have a low cost, heavily diversified portfolio that takes the risk that's appropriate for you, those and systematize your savings also. If you can do all those things, I think you're going to have a phenomenal investment experience.
Speaking of diversifying your portfolio, I wanted to touch briefly on what your thoughts in terms of cryptocurrency and the blockchain are.
Oh, that's great. So let's talk about what that evidence is in passive investing. So we call it evidence-based investing, right? We look at the evidence and we see where it goes. You want to diversify sources of return as much as possible. So think about your career. You want to do the opposite, right? You want to go into your profession. You want to get highly educated, become very confident, and go into it all at once. Well, with your money that you take out of it and invest, you want to do the exact opposite. You don't want it concentrated. You want it spread out amongst so many things, large cap, small cap stocks. So small companies, big companies throughout the world. You want to own international, US, you want to own some commodities, you want to own some real estate inside of there, and all in publicly traded either ETFs or mutual funds. But now, should you include either Bitcoin or blockchain? I think you should consider it. Now, right now, it's also a little difficult at times on how to invest in it. But I just read a survey not too long ago that Fidelity has this managed account. Also, I didn't mention them earlier, but it's very low cost and you can manage it. Of millennials within that platform, 2% of all portfolios or 2% of all the assets were invested in Bitcoin and blockchain. Great. 2% is reasonable. That's a good allocation. I wouldn't ever go above 5. I would think somewhere around 2 to 3% can make a material difference in your portfolio if it does well over time. And then at the same time, if it doesn't, it won't blow up the portfolio. So just like how much US or international companies you should own and all that, you should be practical about being totally diversified, using low cost strategies and stick with it and rebalance that. So yeah, I do think Bitcoin and blockchain can have a presence within a portfolio because it has its own rate of return.
Great. Thank you.
Sure.
Just coming back to how you think that this pandemic will affect people ongoing, both, in the US and beyond. What's your take on that?
Sure. So let me say this right up front. I have a crystal ball, but it's always cloudy. Like I am, remember I talked earlier about, you got to know your risks and all that. I was a professional trader. So I'm always thinking about, what might happen. And then I fight that. And I realize I don't have the information. And I also know that markets at all time, they already have all that information. There are very smart people that all day long compete against each other to find the right price. And that collective group absolutely picks the right price for right now. And so I think that's important to understand. And that plays to that active, passive type of investing. But so I think there's many ways to approach it. Would you frame the question again so that I can?
How do you think this pandemic will affect people ongoing? So we've kind of seen like the immediate impact, and then in terms of like spending habits over time, or what you've seen, if you've read any evidence-based articles
Sure.
on people's behavior.
Unfortunately, like I said, my crystal ball is cloudy, but what I'm going to say is we don't know when we're going to get out of this. We don't know how long it's going to last. I think it's going to be quite a while. You can see the damage to the economy that happened to take proactive steps to help out on the medical side of it, on the public policy side. But I think it's going to be a while. So that informs me that you have to have that good reserve fund. You have to make sure you can survive and thrive through this. I also think the other thing you should do is keep contributing where you can into markets. Prices are depressed because of this uncertainty already, some more than others, and some have even come back. the market already has figured out that it believes that this is going to be a long time, but it's not going to be as bad as it was just a month ago. And so you should keep contributing. Definitely keep that up. Student loans are being deferred now. You don't have to pay on that. It doesn't mean that you don't have to pay towards the principal. So instead of paying towards principal and interest, maybe just make principal payments in there while this is going on. There's very proactive things you could do. But what you should know is that this could be a long cycle. There was a lot of damage done, and you really have to be prepared to ride it out and to be able to survive and thrive, and maybe even create some more capabilities while you're waiting. Take online courses, get another certification, maybe even find a mentor. And everybody's willing to meet now, or many of us are home sheltering in place or just getting out. I think it's a great time to improve your opportunity and improve yourself and improve your opportunity coming out of this.
Absolutely. So, I mean, that actually touched a little bit on my next question for you, which is, what message would you like to send to everyone?
Yeah, what I'd like to say is, of course, my heart goes out to everybody that's suffering, anybody from financial issues or anybody to medical issues. I really want to say I pray for you and I think about you. I also want to say that there's many, many, many of us that are going to have to survive and thrive through this. And I just would like people to know that we've gone through crises before. Mankind is unbelievably creative in ways that they can work with things like this. So what I'd like to say is this too will pass. We don't know when, we don't know how it'll come out. You often don't get to see the signs that tell you everything's okay. And that's the trouble. So I've lived through a lot of crises. I traded through them, and now as a wealth manager uh, to high achieving professionals, we see many of them pivoting a little bit right now and coming up with other sources of revenue in their business or gaining other competencies. I think it's important to know that life will go on. This will pass. No one has a crystal ball that can tell you when or where, but just know that it'll be okay on the other side, and prepare yourself for that now. Do all the appropriate things and steps you can take now.
Okay, and finally, what advice do you have on how to choose an advisor? I personally like you because of your background. I think that it's really interesting that you spent so many years as a trader, and now you've gone more towards, let's look at the evidence and let's consistently do the same thing based on what the science says, not based on my gut or what I heard from somebody or anything like that. So what would you say in terms of advice to pick an advisor?
Sure. I think our industry is completely confusing to the average investor. I think so many people can hold themselves out and say they're a fiduciary or an advisor to you, and they might be in some portion of the relationship and not in others. So I think you really have to do your homework and ask some very good questions of who you work with. So the first question you should ask is, how do you get compensated? And then I would ask the question again. So if they say, oh, I charge you fees on the assets you have, or when I sell you an insurance policy, I get a commission, I would say, how much? And is that fully disclosed? And then I would ask them, is there anything else you get paid? So a trip to Disney World or whatever isn't exactly what I want my advisor to be giving me advice or selling me mutual funds. If it means her and her kids can go down to Disneyland when it finally opens up and on my dime, I want that to be truly transparent. Second thing is what kind of credentialing you have and what is your model of working. So some of the lowest fiduciary responsibilities are insurance professionals. They're loosely governed by the states that they live where they operate in, and they're not held to unbelievably strict standards. So you just have to know that if someone's an insurance salesman, they're a salesperson, and they will want to sell you insurance. That makes sense if it's appropriate for your situation. The next one up would be like a broker or somebody sitting in a bank. When they see you have a bunch of money in your checking account, and they're like, oh, you should talk to our advisor over here. Well, generally those people are brokers, and brokers are regulated by FINRA, and they have what's called a suitability standard. It doesn't mean they have to do the best thing for you or your situation. It just means they have to do something well for you that looks like it could work for just about anybody. I don't think that's a high enough standard for me. I like fiduciary level of care. And by that, I mean the same level of care that your doctor or your lawyer would be held to when they deal with you. That it's a professional level that says all things, all decisions, short and long, have to be made in your best interest. And so I would ask very much about, are you a fiduciary? Will you be a fiduciary at all times? And would you put that in writing in our agreement? at Cogent, the firm I founded, we put it in writing. It's in the very first paragraph of our agreement. And it should be. At all times, we will serve as your fiduciary, even if it's not in my best interest. So I think that's really important. I think the last thing you should talk about with an advisor is, how do you do your financial planning and what's your investment philosophy? One, it should be ubiquitous across their firm. All advisors in the firm should have the same methodology. If it's right across everybody, like evidence-based passive investing that I told you, all of the advisors should do that. And then they should tweak it for your particular situation based on your ability, willingness, and need for risk. So that way, if that advisor, God forbid anything happens to them or they change companies, you don't get a new advisor that walks in and says, yeah, that guy was great. Now we sell everything and we're going with this other strategy. You don't want that. You want to have continuity throughout a firm. So I think those are big things. We also have, and I can offer a link up, the 15 questions you should ask your advisor. It's a consumer report that I wrote a long time ago, and you can go to cogentsw.com and find that. And I think it's really helpful because I think our industry makes it so confusing.
I completely agree. And I can't thank you enough for providing a lot of clarity in these uncertain times and within the industry that you're in, because I think you're absolutely right. There is a lot of confusion for the average investor around that. So I really appreciate your time and expertise today.
Well, just know I had advisors in my life and they were really good people. I didn't always think they connected me with my money. They talked more about returns, but I was raising children. I had a family. I had a burgeoning business where I took a lot of risk. I think they should have leaned into that a little more, but I appreciate that. We've all had our missteps. You got to learn and educate in order to be able to survive and thrive.
Absolutely. And like you mentioned, the 15 questions to ask, Michael has been putting out a tremendous amount of information, both on LinkedIn and on his website. So if you want to access any more, dig any deeper on any of this, like he said, go to cogentsw.com and check that out. And we can contact either Michael or his team there as well.
Absolutely.
Thank you again, Michael. I appreciate your time.
Great conversation. Thank you, Claire. I'm a fan, and thank you so much.
Thank you. Take care.